Academy website. And let's begin. For those of you who don't already know me, I'm a California lawyer, largely retired now, and formerly specializing in personal financial planning. I've held a number of FINRA licenses, Series 3, Series 7, Series 66, and a number of California insurance licenses. But my favorite thing to do for most of my adult life has been trading the markets, learning about the markets, and teaching other people about the markets. I've been trading since 1984, that's over 30 years ago, and I've been mentoring other traders in stocks, futures, and Forex for nearly 15 years, going back to 2000. I'm an NFA CFTC registered commodity trading advisor since 2003. My favorite method in market, and what we're going to talk about today, is day trading the S&P E-mini. My favorite platform is NinjaTrader 7, and my favorite broker is Trenton Kimino at Global Futures in Encino, California. I have a profile on LinkedIn, so if any of you are members of that particular social media site and are not already connected with me, please invite me to join your network, and it'll be a way for us to stay in touch and for you to get information about my trading and upcoming webinars. I also recently put a profile on Facebook after having resisted that for a number of years. So you might also be able to find me there. But the best place to follow the comings and goings of my students and myself is right here on the PacificTradingAcademy.com website. I have a regular blog page. If you go to that website and then click on the blog link and go to Mentor Mike's Market Movies, you will see daily, almost daily postings about my trading, my live trading room, and videos of webinars. And this is where hopefully the video of today's presentation will end up a little bit later on. Now, this is an index of recent webinars. This is something that I provide to my students. It makes it easy to find these webinars rather than having to scroll through the archives with clickable links. And just another little benefit that my students receive. Now, let's get started. One of the questions that you may have had when you got your invitation to this presentation is why all the references to gambling in the promotional materials for this webinar? Well, I'll tell you, folks, it's not just a promotional gimmick. There's a very important psychological reason for us to address this issue. Because I firmly believe that to be a successful trader, you must fully embrace, internalize, and completely be comfortable with the reality that trading is gambling. You may have some unresolved feelings about that, and you might also find that the notion of trading as gambling could be affecting your relationship with your significant other. Wagering, betting, gambling, these all have similar meanings but can have different connotations. When I think of wagering, I think about some proper English gentlemen sitting in the wood-paneled library of their exclusive club, much like Phileas Fogg, the character in Jules Verne's Around the World in 80 Days that was portrayed by David Niven in the excellent cinematic version of that story. In fact, the trip around the world in 80 days was as the result of a wager by these members of the Reform Club. When I'm thinking about the term betting, I envision a couple of good friends watching American football, drinking beer, eating snacks, and sitting in the man cave while they enjoy their favorite sport. But gambling has a slightly more dark connotation in many people's minds. It looks like something that Al Capone might be involved in on the news or in cop shows on TV. We often hear the term gambling linked with prostitution and narcotics and other various illicit activities. So it's a fact that we have a certain visceral emotional reaction to these words, and when we associate ourselves with them, There are impacts on our personalities that we're not always completely aware of. If you meet someone at the proverbial cocktail party and ask the inevitable question, what do you do for a living? Suppose you got these two answers: I trade the stock market, or I'm a professional gambler. Those two answers have really different connotations in the minds of most people, but are they really that far apart? Now, when I'm in that situation and meeting new people, I use the term I trade the stock market. I could equally be truthful by saying the latter one, however. I am a professional gambler, because trading is gambling. Now, if you have a problem envisioning yourself as a gambler and you want to have a more beneficial self-image, here's something to remember. Abe Lincoln said, "You cannot help the poor by becoming one of them." And I personally believe that anyone who has the resources to become wealthy literally has a moral obligation to do so. Wealth is not a treasure to be hoarded. It's the life's blood of society that must continually flow and be shared by every part of the body politic. And if you have trouble seeing how you as a trader fits into all of that, well, I believe that part of a successful trader's value to society is as a professional stimulator of the economy. Every dollar you spend is going to help someone else in some fashion. Now, let's talk for a moment about risk takers and nesters. Now, as far as nesters, I could have used the term security seekers, but you get the idea. In every partnership, whether it's a business partnership or a domestic partnership like a marriage, very frequently you'll find that one of the partners is more of a risk taker and the other is more the security seeker, the nester, the one who's concerned with those sorts of things. In my particular marriage, I, of course, am the risk taker, and my lovely wife is the nester. And it's not surprising that we should have assumed those roles. My father was self-employed. I have been self-employed most of my life. There's only been a very few times that I was ever anyone's employee. But by contrast, my wife works for a school district. Her father worked for the county of Los Angeles, and their idea of a good life was to be a salaried employee for a large institution, settle for a modest salary as long as there are some benefits and a good retirement package. And there's nothing wrong with that. I don't mean to put that down or put any kind of negative qualitative spin on it, but it's not for everybody. And I have always sort of refused to make one of my goals in life to make sure that I have enough money so that I can afford to pay for a good nursing home when I reach the point of drooling and in diapers. So, these are ingrained personality types, and we have to be true to who we are, but we also have to, create working, amicable relationships with the nesters in our life. Nesters tell risk takers things like, well, dreams are great, but when are you going to get a real job? And I'm sure that I'm not the only person who's heard that one before, and I'm sure many of you out there, if not all of you, can relate to that one. The other thing is that the way we risk takers are perceived by others always depends completely on the outcome. The risk taker who wins is a bold visionary, but the risk taker who loses is a reckless fool. And in the beginning years of my trading career, I'm sure I appeared as the reckless fool to my wife on many's the occasion. But I had to remain true to my nature, and to her credit, she allowed me to do that. And the defining moment when the changeover in her mind occurred was the year that I was able to make enough money to pay off our mortgage. At that point, she had to finally acknowledge that there was at least a small element of the bold visionary in me and my crazy desire to gamble on the markets. So my advice to you, risk takers out there, is that if you want to remain true to yourself and still be on good terms with the Nestor in your life, you need to learn from a fellow risk taker how to win big, and win fast. So the online video game that I call Beat the Market is in fact electronic day trading of the Standard & Poor's 500 stock index, also known as the S&P E-mini. And in my opinion, based on 30 years of trading and 14 years of teaching, that market and my method are the fastest way to make the most money with the least amount of starting capital. And this is my opinion, not an indisputable fact, and it's definitely not a guarantee of success. But it is an opinion that I hold very sincerely. So let's begin by asking, how much prior knowledge and experience do I need to play Beat the Market? Well, the short answer is none, because I can literally teach you anything you need to know in 3 months or less. And in fact, I'm going to teach you a lot of that right here today. Now, you noticed earlier that I have a pretty lengthy list of professional credentials in law and finance. This knowledge and experience does help me be a better teacher, but they don't really contribute anything to my abilities as a trader. But that said, I believe that any trader needs the basic knowledge of a competent adult in American society. And such knowledge can really be obtained by simply watching the evening news on any major network. But here is a quick crash course. Here's everything you'll ever need to know about stocks, the stock market, and stock indexes to play Beat the Market. A corporation is a type of company formed for any legal business purpose. It issues shares of stock that represent a percentage of ownership in the company. The shares can be privately or publicly owned. The stock market is where shares in public companies are traded. A stock index is a sample group of stocks that represent the overall market. Examples include the Dow Jones Industrial Average, which, by the way, is made up of just 30 stocks, the NASDAQ 100, 100 stocks, and the Standard & Poor's 500. That's the index we're talking about today. Now, here's everything you'll ever need to know about futures to play Beat the Market. Futures contracts were invented in the 1850s for two main reasons. One, to trade essential commodities like grains and meats in standardized quantities and with a specified level of quality. And also to allow the producers or consumers of the commodity to lock in favorable prices before making or taking delivery of the actual product. However, nowadays, only about 2% of futures traders are actually interested in the product. 98% of traders are simply wagering on the direction of price. Here's some more about futures. Excuse me. Over the years, many products were added to the roster of things traded in the futures format, including intangible financial instruments like treasury bonds and stock indexes like the S&P 500. The first electronically traded futures was, in fact, the S&P E-mini, launched in 1997. Now, an S&P E-mini's trader's ticket into the game, if you will, is a refundable good faith deposit called margin. The margin for overnight position traders is set by the Chicago Mercantile Exchange and is currently $4,600 per contract. Bit pricey. But the margin for day traders is set by their own brokers. And my day trading margin, and it could be yours as well, is just $400 per contract. Big difference. So here's a recap of why we day trade the S&P E-mini futures to play Beat the Market. My students and I bet on the direction of the overall U.S. stock market in the form of the S&P 500 index, specifically by electronically day trading the S&P E-mini futures. Futures allow us to post a margin deposit to gamble on market direction without having to actually buy or sell any stock. Day trading allows us to post a deposit that is less than 10% of the overnight margin. And electronic trading allows us to do it all from the comfort of our own homes. So how does this trading process work? Well, that's a pretty broad, open-ended question. So let's zero in on how we solve the most common problems, which are entering the trade, setting profit targets, trailing the stop, knowing when to hold them and when to fold them, and recovering from a loss. Problem number one is entering the trade. If you stop to think about it, you very quickly realize that a good day trader's skill set is virtually the same as that of a good video gamer. And this is particularly true of my style of day trading. The skills you need are the ability to spot signals, track a moving target, patiently wait for a setup, be able to pull the trigger without hesitation, and keep a cool head throughout the process. Because of those similarities, I refer to my style of trading as playing the video game Beat the Market, because in many ways that's exactly what we're doing. Now, continuing on, quick, I want you to name the colors of the American flag in your mind. Did you say red, white, and blue in that specific order? If you did, your brain is already programmed to spot our color-coded entry signals. In general, what we do is this. If you see an alignment of red, white, and blue from the bottom up, go long. If you see those colors line up from the top down, go short. Here's an excerpt from one of my recent charts. You got four indicators on here. See the red, white, and blue from the bottom up? Red, white, blue, we go long. Bet that the market's going to go up. You got that here, and you got that over here on the right side. If you see red, white, and blue in alignment from the top down, you go short and bet the market is going to go down. It doesn't get much easier than my style of trading. Now, continuing on. NinjaTrader, my favorite platform, has over 100 indicators. We use just 8 of them. Here's the list. Donchian channel, parabolic SAR, simple moving average, volume oscillator, MACD, average true range, bar timer, and pivot points. In addition, we look for just 2 signals. Just 2. The crossover and divergence. What's the crossover? Well, just as the phrase implies, you got one line crossing another line. In this case, when the price crosses the red parabolic SAR, it causes it to change directions. So we go from our bearish alignment of the red, white, and blue to the bullish, to the bearish, to the bullish, and also bearish once again. Now, the junction where this change occurs is the crossover signal that I have marked with the yellow X's. Now let's take a look at divergence. Divergence involves our oscillators. I use a pair of MACDs flowing at different speeds. MACD, by the way, is an acronym for a much larger name, Moving Average Convergence Divergence. Now that's quite a mouthful. That's why we shorten it to MACD. But check this out. Here's that junction between the bearish move and the bullish move. And notice that divergence is simply a comparison between 2 points. But it's 2 points on the price, and 2 points on the corresponding indicator. Here you can see the price made a low. There was a little 3-part corrective bounce and then a sell-off to a lower low. On the MACD, we have a similar sort of movement, but the second low is not a lower low, it's a higher low. So when you connect those points with the straight trend line, we have the downsloping line on the price, but we have the upsloping line on the indicator. What that tells us is that there was less selling pressure, less momentum pushing the price down for that final low than there was for the first one. And even though the price got to a lower low on the price scale, it was bound to be a bottom. So when we get that confirming crossover signal after the divergence, we can take this long trade with a high degree of confidence. That's it. You've now learned just about everything you'll ever need to know about technical analysis and selecting the direction of price when you play Beat the Market. Now, problems number 2 and number 3 are setting profit targets and trailing the stop. For these, we need the help of an external metric. What's that? Well, an external metric is a measuring device, metric, taken from the movement of the market itself and thus external to our own emotional mind. Our 2 money management external metrics are indicators devised by Welles Wilder, the author of the Delta Phenomenon and founder of the Delta Society. And there's the website for the Delta Society. If you haven't already visited them, it might be worth a look. We set our profit targets with the help of Wilder's average true range, also known as the ATR. And we trail our protective stops with his parabolic SAR. SAR, by the way, is an acronym for stop and reverse. Let's take a closer look at each of these. When it comes to setting profit targets, our targets must be rational and reachable. They must be custom tailored to the market's current volatility. Now, what exactly is that? Well, volatility is the price's ability to move vertically on the price scale within a certain period of time, and we measure volatility with the ATR. When you got a steep trend that goes up or down in a short amount of time, that's high volatility. If you have a prolonged sideways consolidation where the market moves up and down very little but consumes a large amount of time, that's low volatility. In general, the higher the volatility, the further away we can safely place the profit target. But the lower the volatility, the nearer the target has to be. This is one of my charts, and this yellow arrow is pointing to the average true range. Now, the average true range also includes this red line here, but it's the only thing that we really value is the numerical designation that is contained within that little red pennant that the yellow arrow is pointing to. Now, it's critical that you know how to calculate the ATR from that numerical information, and that is something that is covered very thoroughly in my course, and all my students know how to do it very well. Now, the other part is trailing the stop, and for that we use the parabolic SAR, another brainchild of Welles Wilder, and it's also based on market volatility. It gives the market sufficient breathing room while describing a parabolic arc that slowly gets closer to the price action over time. It creates the perfect guide for trailing the protective stop that eliminates the guesswork of trying to determine where to put the stop and also when to move it. Now, you all know that fear and greed are the enemies of the trader. And unfortunately, we are all pretty well hardwired as emotional beings. We can't really change that, but what we can do is we can train ourselves to habitualize certain behaviors. And the object here is to trust these external metrics. The average true range as a way of setting targets, and the parabolic SAR as a way of trailing stops. If we convince our subconscious mind of the logic behind this, and then we practice it repeatedly so that it becomes second nature, we don't exactly get rid of fear and greed, but we keep them in check by creating a habit that overrides their negative effect on us. Now, here again is the parabolic SAR. The parameters of this indicator have been specially crafted so that the parabolic will change direction at or about the point at which our price crosses the white swing-defining moving average. So you can see that in this short trade, for example, we would get in at the first crossover signal and we would exit at the next crossover signal in the opposite direction. Now, it's always the fact that you're never going to get the first dime of the new move, nor are you going to get the last dime of the move that is ending. But that's okay, because we get the amount that's in between, and you do that often enough, and you will be very prosperous. Problem number 4 is knowing when to hold them and when to fold them. Now, there are 2 very important cosmic truths of trading you need to embrace here. Every good trade will have a red, white, and blue alignment of our indicators. That's an absolute fact, and it's beyond dispute that every good trade will have a red, white, and blue alignment of our indicators. But not every red, white, and blue alignment of our indicators will result in a good trade. Now, at first blush, the first cosmic truth there sounds like the beginning of a philosophical syllogism. You know what that is, right? Remember this one? All men are mortal. Socrates is a man, therefore Socrates is mortal. It sounds like, well, every good trade will have a red, white, and blue alignment of our indicators. We currently have a red, white, and blue alignment of our indicators, therefore we must have a good trade. Well, unfortunately, it doesn't work like that. Sometimes you can get the alignment, but the market simply doesn't cooperate. It doesn't go far enough to hit our target, or it just fakes us out altogether. Because of this strange dichotomy and these opposing cosmic truths of trading, if you will, we must develop our damage control mindset if we're going to have any hope of really knowing when to hold them and when to fold them. And I want you to meet the man who can help us with that. Here he is, Ralph Nelson Elliott. Now, some of you are going to immediately be put off by this, and I understand. Elliott wave theory can be very difficult, it's complex, it's subjective, it's all those things. I agree with you. Now, stop where you are and pause. Think of this. You don't have to know every nut and bolt in the engine in order to drive the car. And you don't have to be an expert at Elliott wave theory in order to put it to practical use in your trading. So keep an open mind. Many students have asked me, Mike, can we just use the technical indicators and not deal with Elliott wave theory? And in answer, I point to these 2 cosmic truths of trading. If it were only the case that every red, white, and blue alignment led to a good trade, we wouldn't have to deal with Elliott wave. And we probably wouldn't have trading as we know it, because the red, white, and blue alignment would suddenly become the holy grail of trading, and it wouldn't be our secret for very long. But the reality is that we need an additional filter. And in the early 1930s, Elliott began his systematic study of 75 years of stock market data, including index charts, with increments ranging from yearly to half-hourly. In August of 1938, he detailed the results of his study in his book entitled The Wave Principle. Elliott stated that while stock market prices may appear random and unpredictable, they actually allow predictable natural laws. They actually follow predictable natural laws, rather, and can be measured and forecast using Fibonacci numbers. And as I said earlier, you don't have to be an expert to make practical use of it, just like you don't have to be a mechanic in order to drive your car. So let's take a look at how Elliott Wave might benefit our damage control mindset. Now, to begin with, we all have to appreciate that to err is human, and we are all human. Now, that's for sure a philosophical syllogism that works. But do not panic. You can fully recover from many mistakes, or at least minimize their negative effect, if you stay calm and remember this cosmic truth of trading, which is the market is constantly oscillating up and down on all time frames. Now, what does that mean for us? It means that often we attempt to enter a trade in the direction of the trend after a corrective bounce or pullback, but we find that we've jumped the gun. The corrective move was not finished yet. It still had one more loop or zigzag to go, and as a result, it begins to move against the direction of our trade. But remember, if you hold on, the correction may eventually give way to the trend because corrections tend to break out in the same direction that led into them. Now look at this little graphic over here in the lower right corner of this slide. I don't think it's specifically designed to resemble an Elliott wave pattern, but it does. You can see we've got kind of a 5-wave impulse pattern here. 1, 2, 3, 4, 5. Bullish one, in fact. Now suppose that we get in this trade kind of near the end of this rally. The market moves a little bit in our favor, and then all of a sudden it starts to sell off. Now, if we are able to recognize that this is in fact a bullish impulse pattern and that we have inadvertently stumbled into a corrective wave within that pattern, we might have the wherewithal to hang on to the trade until the market turns around and makes our trade profitable. But that, of course, implies that we know how to recognize the corrective wave in the first instance. So having a basic knowledge of Elliott wave theory, especially the corrective waves, can definitely improve your win percentage by helping you know when to hold them and know when to fold them, with apologies to Kenny Rogers, who now is on TV in a I think it's a Geico insurance commercial you might have seen. That's kind of coincidental, I find. Now, here is one of my recent webinars from this past spring, Elliott Wave, Just the Essentials. It's an hour long. A few months later, I did one in July called Elliott Wave, More Essentials. In addition, I do an Elliott Wave chart of the market every single day. This is a collage of some of my Elliott Wave charts for the month of September. See this one that's highlighted right here? Here's a close-up of it. Here's my point. If you watch those two webinars of mine, you're going to know as much about Elliott wave theory as you will ever need to know to be an excellent trader. Now, as with most skills, it's not just the knowledge, it also requires practice and repetition to solidify that knowledge into muscle memory, if you will. Well, this is why we do an Elliott wave chart every single day of the S&P. We base our Elliott wave charts on the day session only because we found that the Elliott wave patterns flow continuously from one day to the next on the day session chart. So if all you do is just look at these and let it sink in, you will probably become a top flight Elliott wave analyst by osmosis, if nothing else. So it's not as difficult as you may think. It is complex if you let it be. Now, I have been lauded as a teacher for my ability to, and I hate to use the term dumb it down, but that's kind of what it is. I prefer to say that I have a facility for taking complex targets and complex topics and distilling them down to their essence. This is what I try to do with Elliott Wave. Now, it'll take a while, but it's my firm belief that if Elliott Wave is too tough for you and you don't want to do it because it's just too hard, well, then you're going to have to kind of resign yourself to being a mediocre trader. Because pure technical analysis, as much as I love it, won't cut it because of those two diametrically opposed cosmic truths of trading we looked at earlier. You cannot rely exclusively on technical analysis. We need an additional filter. And this doesn't make it 100% certain either, but it gives us a leg up. And because of its potential complexity and its subjectivity, it turns a lot of people off. So what that means to me is the ones who take the trouble, who make the extra effort to actually learn a working knowledge of Elliott wave theory, they're the ones who prevail. Now, let's look at problem number 5. How do we recover from a loss? Well, of course, the best strategy is to avoid losses in the first place. So, to maximize our win percentage, we use a peeling off strategy, 9 contracts and 3 targets. And when the first target is reached and filled, we enter a stress-reducing free trade. What's a free trade? Well, it is a multi-contract or multi-instrument strategy where you exit a portion of the position and obtain sufficient closed profit to cover the transaction costs of the entire position. You can then ride the remainder of the position to further upside potential without the possibility of loss. Now, I must pause here because as a registered commodity trading advisor, I can't run around saying things like without the possibility of loss. There's always the possibility of loss. But let's say that if you get into the free trade situation, you still have upside potential, but the possibility of loss has been significantly diminished. In addition, it greatly reduces the stress of having to sit there and watch the market move and shrink before your very eyes while you continue to wonder if you're going to have a winner or a loser. You don't have to worry. You're pretty much locked into a winner. Now, the goals of a free trade are to set a logical, reachable target, that's why we use our average true range, that when hit earns enough profit to cover the entire transaction cost with a small extra cushion. The small extra cushion is then used, or most of it is used, to provide an appropriate protective stop for those contracts that are still in play. In addition, we automatically move the stop to a position that protects that profit, but still at the same time keep the stop as far as possible from the price action to minimize the chance of premature stop out before reaching further profit. So the peeling off strategy helps us increase win percentage, and it also has the psychological boost of creating the free trade. Now, every benefit has a cost. Although the peeling off strategy can boost our win percentage above 90%, an occasional loss is inevitable. And an unfortunate aspect of peeling off is that a loss is taken on the entire position, but profit is gathered in smaller increments along the way. And if one's daily score goes into the negative, many traders respond to such a financial and psychological setback with a sort of double or nothing attitude. They will increase the number of contracts traded and thus increasing significantly the risk as well in an effort to dig out of the hole. That can be very, very dangerous. Our come from behind strategy, also known as CFB mode, uses the same number of contracts, but we consolidate our contracts at a single target at the average true range of a higher time frame. Now, in typical peel-off mode, if we hit the third target, our accumulated profit from all three targets is approximately $633. If we consolidate all contracts at the third target position, potential profit becomes over $2,300. However, it's another cosmic truth of trading that the market makes far more small moves than large moves. Now, what does that mean for us? Thus, in order to effectively invoke the CFB mode, we need a high probability that the market will deliver one of its larger moves, a with the trend impulse wave. So this is one more reason for my sincere belief that good traders need the basic working knowledge of Elliott wave theory that I teach in my course and that I apply in my live trading room. Now, let's take a little look at another cosmic truth, that of the good trader. There is no such thing as a natural-born trader. We all start out with the same emotional flaws of fear and greed. Good traders become that way by acquiring the knowledge and skills they need through hard work and constant practice. Most good traders realize that modeling the methods of an experienced trading mentor is preferable to reinventing the wheel on their own. I also believe in the cosmic truth of the Pareto principle, also known as the 80-20 rule or the law of the vital few. In most human events, roughly 80% of the effects come from 20% of the causes. In trading, it means that about 80% of traders consistently lose and about 20%, 1 in 5, consistently win. So I want you to ask yourself, could I become one of the vital few? Well, if so, I'm looking for a vital few good traders to join Mentor Mike's Gadget, an acronym for Grand a Day Group of E-mini Traders. Again, I can make no guarantees, but it is my sincere personal goal that I help every student become a competent and confident trader with a win percentage of 90% or better. I want to help many students earn enough to pay for the course within 3 months. I want to help some students earn $1,000 per day or more within a year, and I want to help a vital few students earn $1 million within 5 years. I am totally serious about this. So are you interested? If you are, you need to go here and check it out. On the PacificTradingAcademy.com website, go to the enrollment link and Mike Bridges' mentoring course and trading room. There you'll read all about it, including the entire course outline. When you're ready, you can check out the price and the payment plan. Basically, the course is $5,000, and that's half what I want to charge because I think it's easily worth $10,000. We're talking about teaching you the skills that are going to allow you to earn $1,000 per day and thus become one of the top 2% of American taxpayers who earn over $250,000 a year. I think $5,000 is way too cheap, but I've been outvoted by the board at Pacific Trading Academy, so my loss can be your gain. Now, when you're ready, go to the page where you fill out your information, give your credit card data, and I'll be getting in touch with you to tell you what you got coming. Here it is, basically. You have 3 months access to 8 video lessons that I have produced specifically for this course. You'll get up to 12 one-on-one hour-long phone or Skype conferences with me, and you'll get 3 months access to our twice-a-week trading room live. We begin at 7 a.m. Pacific time and we go to 12 noon Pacific time. That's twice a week. 5 hours each time, 10 hours a day, 12 weeks. That's 120 hours of live trading with me at your side. That's like 3 solid full-time 40-hour weeks of trading with your mentor. In addition, I send out daily email updates with screen captures. I do this not only on trading room days, but also on Monday, Wednesdays, and Fridays to show my personal trading. And if you excel, and I can tell that you're really serious about all this, you have the option to extend your time in the trading room on a month-to-month basis. The all-inclusive tuition is $49.90, payable basically $3,000 down and another $2,000 in 30 days. The optional trading room extension is $100 a month. If you're a PTA grad from another mentor and you want to come in the trading room, the cost would be $100, but you also have to convince me that you are prepared for it because not everybody is accepted. Now, the big question about making this happen, is $1,000 a day a realistic goal? Well, let's take a look at some of my personal trading. I'm going to show you just last week. Here's Monday, the 22nd of September. In my personal account, I made $1,063. Tuesday, which happened to be a trading room day, I made $1,051.50. Wednesday, $1,100.50. Thursday, another trading room day, $1,338. And Friday, yesterday, $1,071. Here is the tally for last week. And as you can see, the average was a little better than $1,100 a day. Now, I don't win every trade. I don't even win every day. And if you go back in the archives on my blog page there, you'll see other market movies and videos of webinars where the daily average for these weeks has been a little less than $1,000, $800, $900, whatever. Like I say, don't win them all, but I win a lot. And I know how to teach you how to win a lot. Here's the screen capture of the trading room chart from Tuesday. We did, $1,051.50. And here's the one from this past Thursday, $1,527. So in theory, folks, if you had been in the trade room with me, trading live on your own account, and you took the same trades that I did, got the same fills, and if you were trading my 9-contract, 3-target peel-off strategy with the occasional use of the CFB mode, this could have been your score. And by the way, all of the scores you saw are net of $6 per contract transaction cost. Now, everyone says, well, you've been doing this for 30 years. Let's hope you know what you're doing. But what about your students? Well, here's an excerpt from an email I got last week from Kevin K., current student from Pennsylvania. You've heard me talk about Kevin K. before. It says, I decided to start the 21-day simulated trade program and really treat it like I was doing it for real. I have 3 successful days trading for total profits of $3,283.72, which includes today, screenshot attached. We'll look at that in just a second. I really want to be one of your top students, and I feel like I can be if I really concentrate on this. Now, what's he talking about with the 21-day simulated trade program? Here's a little something that I tell my students. Demo trading has its value and it has its limitations. My charts are carefully constructed for my benefit and for what catches my eye and registers on my brain. But it's another cosmic truth of trading that we don't all see the same things in the same way. So demo trading really has 2 phases for my students. First of all, you have to construct a chart template that really works for you. You need to do a little bit of experimenting with different indicators, different settings, different time frames until you feel one that is really comfortable for you, keeps you in your comfort zone. Once you've got that, you then enter the testing phase of the demo trading program. And there you need to go for 21 trading days minimum without making any changes in the charts or the indicators and without any do-overs. The idea is that 21 days has been pointed to by psychologists for a long time as being the minimum amount of time you need to habituate behavior. And it's also roughly the equivalent of a calendar month in terms of trading days. So you'll have an opportunity to see a fairly wide range of market conditions and be able to test your skills against that variety of conditions. If you can be profitable at the end of that 21-day period, then there is no reason why you cannot do it live with real money. So I'm not about to throw you in the lion's cage until I know you can handle the whip in the chair. And this is one of the ways that we do that. So Kevin's been at it for a while. He's shown great promise, and I have no doubt in my mind that he is going to be a 2%er in very short order. He's got everything it takes to make $1,000 a day. I'm immensely proud of him, and I know that there's some more folks out there possibly listening to this presentation right now who have the same capabilities that Kevin has. So think about it. Now, here's Kevin's chart that he sent me along with that email. He made something over $1,200 on this particular day. Now, it is demo dollars, but you have to walk before you run, folks. If you can do it on the demo platform, and if you can habitualize that behavior, that discipline, then you will be able to make the smooth transition to live trading. And I'm going to help you every step of the way. So, in answer to the question, is $1,000 a day a realistic goal? The absolute answer is yes. Now, if you're still not convinced, I want you to guess what these 17 dates have in common, ranging from July 25th through yesterday, September 26th. Well, I'll tell you. On those dates, I recorded myself trading in real time and making $1,000 or more before your very eyes if you watch those videos. Mentor Mike's real-time video trading room. Most of these videos range from about 3 minutes to maybe a maximum of 12 minutes. You watch them and you'll see exactly how I enter the trade. You'll see I turn the video on as I enter. Sometimes the targets get hit, and then I turn the video on and show you that the target was hit. Sometimes if I see that the price is getting close to the target, I'm able to turn on the video, and you actually see the target get hit right on camera. But you can see it's all real, no smoke and mirrors. Industrial Light and Magic didn't come in and do, computer-generated graphics or anything. It's all done real time, on camera, and I only started doing it recently, and so far I've only logged, 17 videos. I'm sure there'll be more. Now, if I can do it that many times, I can assure you that I can keep doing it virtually on command. Now, does that sound like the kind of guy you'd like to teach you how to make the most money possible in the least amount of time with the least amount of starting capital? Well, if not, I don't know what else I can really tell you. Now, some of you may be position traders and not have the ability currently because of your employment situation or perhaps caregiving obligations where you can watch the market in real time, but you still want to learn how to trade. Well, I have a course for position traders as well. It has all the same elements and it's the same price as my day trading course, except there's no trading room, and in substitution of that, I have increased the number of one-on-one conferences by 50%, so from 12 to 18. So if you want to learn how to do this as a position trader, I can help you there. But again, you got to appreciate that it's a tougher nut to crack, because remember what I told you earlier about margin. The overnight margin on the S&P is $4,600. The day trading margin is $400. It's much easier to trade multiple contracts when all you got to pony up is $400 a contract instead of $4,600. But if you want to learn the technique and practice it, so when the time comes that you can devote more time, you can really hit the ground running, well, I wanted you to know that that's available. And folks who take that course, of course, will be able to get into the trading room later on the optional month-to-month basis. Now, if you have any questions or comments, I'm not going to be taking any questions here today. That's always kind of an awkward situation, and so I would prefer that if you have a question that you give some thought to it, put it on paper, send it to me in an email, and please include your phone number and time zone, because if your question requires more elaboration than I care to type out, I'll give you a call, and we can talk about it. So questions, comments, any of that kind of stuff, MentorMike@charter.net. Include your phone number and your time zone. Or better yet, get serious. You know in your heart you're the risk taker in the family. Show the nester in your family that you are the bold visionary and not the reckless fool. Learn how to do this and become my student now. And to do that, go here. Well, we are just about out of time. I want to thank you once again for taking the time out of your busy, relaxing Saturday to come and watch this show. I hope you got something out of it that's going to be a benefit to you. And, come and visit Pacific Trading Academy when you're ready to get serious. All right, that's it. Everybody enjoy the rest of your weekend. Bye-bye for now.